Last night I made a video on TikTok talking about how I plan to invest during a recession, as many people seem to think we're heading into one if we aren't already in one, that we're heading into one in 2023. And my video was basically like how I plan on investing in a recession. And somebody left a comment saying, forget about recession, we might be headed into a depression where it takes you 20 years to break even. And I wanted to explain in a more long form video here on YouTube why that will never happen to an investor like me. So here what we have on the screen right now is the Dow Jones Industrial Average going all the way back to like the 1920s, right before and during the Great Depression. Right here, August 1929, Dow Jones, all-time high, 6,500, 65.45 and 10 cents. According to this person's scenario, it will take me 20 years to break even on my investment. But this only is true if I do one thing, which is invest once at all-time highs and never again. But if you follow me on TikTok or here on YouTube, you know I'm a big fan of not only buying one time, but buying several times, buying dips at dollar cost averaging, doing a hybrid of lump sum investing and then averaging in over a period of time, especially in down markets. You know, we're not trying to time anything here. No one's trying to time the bottom. No one's sitting there going, this Tuesday is going to be the best time to buy and then everything is going to recover. Sure, you see people like that on TikTok nowadays making their predictions, but that's not really my speed. So Dow Jones, you invest once and never again at August 1929 at all-time highs, and then the rug falls out. And the next thing we see is May 1932, and everyone is going around going, oh, the world is ending. You know, people are ending their lives. They've lost fortunes. It doesn't take very long for things to have a V-shaped recovery. As you can see, you're looking at the V-shape. Now, it doesn't get right back to its previous levels right away. We drop from 6,500 all the way down to 972 over the course of a couple of years. And then if we go to the third image that I have, many years later, right, around 7 years, it takes for the markets to recover almost a little more than halfway to 3,900, almost 4,000 for the Dow Jones. The way I plan on investing in a recession or a depression is to be buying a little every month, so that I'm not running into the scenario where I dump everything in all at all-time highs and then I have to wait during a recession or a depression 10, 20, 30 years. So the last image that we have on the screen here, you can see it takes almost 30 years. Almost 30 years. We jump from 1929 to 1959. If, according to this person on TikTok in my comments who was saying it'll take you 20 years, in this scenario, in the Great Depression scenario, it ends up taking you almost 30 years to get back to break even. But this isn't going to be a problem for us because we're going to be dollar cost averaging every month, even as markets are getting worse and worse and worse. Not individual stocks, although if that's how you roll, that's how I roll in a lot of ways. I buy individual stocks, but I'm talking index funds, broad market index funds. Something like SPLG, VOO, SPY, one of those, or total index fund like a VTI, Vanguard Total Index Fund, something like that, averaging in every month, you recover fairly quick. And if you're throwing in even more money, as I do in bear markets, you might even recover faster because you're averaging down at a lower price point, right? So I'm not trying to time the bottom. I'm not saying, oh, I'm going to go all in at 972 because that's the bottom. I don't know where the bottom is. You don't know where the bottom is. No one knows where the bottom is. But the only time this is bad is, look, it takes you almost 30 years to get back to where you were break even. In this reality, if you start investing in your 30s or 40s or 50s and you have 30-year timeline, just it is sitting there going, when am I going to get back to even? You might unfortunately pass away in that time. That's why I'm not a big fan of just dumping everything in once and then forgetting it. I like the dollar cost average hybrid approach. So one of the things that I do as an investor, and I'm going to wrap this video up soon, is when I see a position that I really like in a company, I'll go in pretty heavy. Unless we're in a bear market. And then I'll divide it up into blocks of, like, say I want 100 shares. I'll buy blocks of 25 at a time if markets are heading lower and lower and lower. And at a certain point, I might run out of money. That's okay because I'm a long-term investor. I've got a long-term horizon. But I've averaged in starting up here, then a little here, then a little here, then a little there. Now, maybe it drops even lower and I've run out of money, but that's okay because I've averaged my cost down enough in a quality investment. It has to be quality. It can't be garbage. That's the differentiating factor here, is you can't be putting your money into junk, high-risk, speculative stocks. Then you're just throwing good money out after bad, and the stock might never recover, which is why I'm a big fan of the index fund or really large cap, high quality companies that have a proven track record of riding out recessions or economic downturns. So if you thought this video was helpful, hit the follow, hit the subscribe. Thanks for watching, and have a good day.